Hello and welcome. If you've ever felt like you were always a step behind the market buying into a hot sector just as it cools off, or missing the next big trend entirely, you're not alone. You're experiencing one of the most persistent challenges in investing: timing. But what if there was a way to anticipate, rather than just react to, these shifts? A framework that acknowledges the economy moves in cycles and different parts of the stock market thrive in different seasons. This is the core idea behind sector rotation. It's not about picking individual winning stocks. It's about understanding which groups of stocks like technology, healthcare, energy, or consumer staples are likely to lead the market next, based on where we're in the economic cycle. In this video, we'll demystify this powerful concept. We'll show you the classic sector rotation model and explain how you can use it to make more informed, strategic decisions in your portfolio. So, let's learn to rotate with the cycle. To understand sector rotation, we first need to revisit the economic cycle. The economy doesn't grow in a straight line. It expands, peaks, contracts, and troughs in a continuous loop. Think of it this way. Different sectors of the stock market are like different plants in a garden, each has its ideal season. So let's walk through the classic sector rotation model, often visualized as a clock or a wheel. We'll follow it through four key phases. Phase 1 is the early cycle, or the recovery. This phase begins as the economy is coming out of a recession. Interest rates are low, central banks are stimulating the economy, and confidence is slowly returning. The leading sectors here are the cyclical and sensitive ones. Financials, for example. Banks benefit from a steepening yield curve and increased lending activity. Then you have technology. Companies see renewed business investment, and consumers start spending on new gadgets. And finally, consumer discretionary. People start spending on wants, not just needs, things like cars, travel, and luxury goods. Phase 2 is the mid-cycle, or expansion. The recovery is now a confirmed, broad-based expansion. Corporate earnings are growing strongly, and the economic data is looking very positive. In this phase, the baton passes to sectors that benefit from sustained growth. Think about industrials. As businesses expand, they invest in machinery, equipment, and infrastructure, and also materials. The demand for raw materials like steel, chemicals, and lumber increases as construction and manufacturing ramp up. Next up is Phase 3, the late cycle, or slowdown. At this point, the expansion is mature. Growth starts to slow, inflation often picks up, and the Federal Reserve might be raising interest rates to cool things down a bit. Here, investors become more defensive and seek out companies with stable earnings. Energy often performs well as inflation rises. Then you have healthcare and consumer staples. People need medicine, food, and household goods regardless of the economic weather, so these are called defensive sectors. Utilities are another classic defensive play, often sought for their reliable dividends. Finally, we hit Phase 4, recession or contraction. The economy is shrinking. Corporate earnings are falling, unemployment is rising, and pessimism is high. In this phase, it's all about pure defense and anticipating the next recovery. Consumer staples and healthcare remain resilient. Utilities continue to be a safe haven. But late in this phase, astute investors begin positioning for the next early cycle. They start buying beaten-down sectors like technology and financials at what they hope are low prices, getting ready for the turnaround. So, how do you actually put this knowledge to use without needing a crystal ball? You use indicators and simple instruments. First, you need to know your economic dashboard. You don't have to be an economist, but tracking a few key indicators can help you gauge the cycle's phase. Keep an eye on GDP growth. Is it accelerating or decelerating? Watch interest rates. Are they being cut, held steady, or raised? Look at the yield curve. Is it normal or inverted? An inverted curve often signals a late cycle environment. And finally, check the leading economic indicators, or LE, which is a composite index designed to signal peaks and troughs. The next step is to use the right vehicles, and the easiest way to implement a sector rotation strategy is through sector ETFs. Instead of trying to pick the best energy stock, you can buy the entire energy sector with a single fund. For example, there's XLK for technology, XLF for financials, XLV for healthcare, XLP for consumer staples, XOL for energy, and XLI for industrials. These ETFs give you clean, low-cost exposure to an entire sector. Now for a practical, conservative approach, the tilt. Double quotes for most individual investors, trying to time these rotations perfectly is a fool's errand. The smarter approach is to use this knowledge to tilt your portfolio, not completely overhaul it. For example, let's say the leading indicators suggest we are in a late cycle environment. Your core portfolio, maybe 80% of it, stays in a broad, diversified index fund like one that tracks the total stock market. This ensures you don't miss out if your sector call happens to be wrong. Then, with your tilt portion, the other 20% you could overweight defensive sectors like consumer staples and healthcare. You're not betting the farm, you're just making a strategic adjustment based on the economic weather forecast. It's really important to understand that sector rotation is a powerful framework, but it is not a guaranteed profit machine. There are some critical limitations. First, the model is a guide, not a gospel. The classic rotation model is based on historical patterns, but future cycles may not play out exactly the same way. Things like technological disruption, geopolitical events, or unprecedented monetary policy can distort or shorten the phases. Second, timing is extremely difficult. Identifying exactly when one phase ends and another begins is nearly impossible in real time. By the time the economic data confirms a new phase, the market has often already moved. This is exactly why the tilt approach is much wiser than aggressive, all-or-nothing trading. Third, don't ignore valuation. Just because a sector is supposed to outperform in a certain phase doesn't automatically mean it's a good buy. If defensive sectors like utilities have become extremely expensive during a rally, their defensive properties might be diminished. You should always consider valuation in your decisions. And finally, consider the cost of being wrong. Frequent trading based on sector rotation calls can lead to high transaction costs, tax inefficiency from short-term capital gains, and the risk of being whipsawed. That means selling one sector just before it rallies and buying another just before it falls. So let's quickly recap. What is sector rotation? It is a strategy of shifting your portfolio exposure to the economic sectors that are expected to outperform in the next phase of the business cycle. The framework suggests that the early cycle favors financials and tech. The mid-cycle favors industrials, and the late cycle favors defensives like staples and healthcare. How do you use it wisely? Use economic indicators to inform your outlook, implement tilts using sector ETFs, and always keep the majority of your portfolio in a diversified core holding. Sector rotation teaches you to think like a gardener, not a hunter. You learn which seeds to plant for the coming season while maintaining a diverse and resilient garden that can withstand an unexpected frost. It's a strategy for adding a layer of sophistication and awareness to your investing, helping you avoid the classic mistake of chasing yesterday's winners. Use it to inform your strategy, not dictate your every move. Thanks so much for watching. If you found this helpful, please give this video a like and subscribe for more content. We'll see you in the next one.